Here's a question so many of us face. Should we put extra cash into our 401k or focus on paying down your mortgage faster? You might think one is obvious win, but what if I told you that choosing the wrong one could cost you more than you realize? Today, I'm going to break down the pros, the cons of each. So by the end of this video, you will know which option is right for you. I remember talking to a friend who was juggling this exact question. They saved up to a nice chunk in their 401k, but they also had a hefty mortgage balance. Every extra dollar went into paying down that mortgage, just for the peace of mind, right? But a few years down the line, they look back and they realize they missed out on some serious growth in their retirement savings. The point is, this decision isn't one size fits all. Both options can be great, but they serve different purposes. Let's dive in so you can make the best choice for your situation. So first things first, right? Let's talk about pretty much what each option brings to the table. So a 401k contribution, putting money into a 401k means it grows tax deferred, which means you're letting that money compound over time without getting taxed until you withdraw it. Plus, if your employer offers a matching contribution, you're getting free money. So skipping out on that is leaving money on the table. So the mortgage payoff, which is paying your mortgage off, gives you that peace of mind. It's like getting a guaranteed return equal to your mortgage interest rate. So if your mortgage rate is 4%, every dollar you put towards the principal is like earning a 4% return by reducing future interest payments. No mortgage also means more cash flow, which can be really freeing once those monthly payments are out of the picture. Both options have solid advantages. The real question is, which one serves you better right now? So, all right, here's a few questions to ask yourself that can make this decision a lot clearer. What's your mortgage interest rate? As a rule of thumb, if your mortgage interest rate is below 5%, it might be better to put your money into the 401k, where your potential growth could outpace the interest on your savings on the mortgage. Do you get an employer match? If your employer offers a match on your 401k, definitely try to contribute enough to capture the match. It's an instant 100% return on your investment. What are your retirement goals? That's things you gotta think about. Are you behind on your retirement savings and hoping to build up fast? Or are you on track and more focused on the security of paying off debt? If you need to catch up, prioritize your 401k. But if your retirement is on track, mortgage payoff can add some security. So these questions should give you a good idea of where to start. Let's talk about the financial versus the emotional return you're getting from each option. So the financial return, if your mortgage rate is low, your 401k is likely to give you a better return because the investment tends to grow faster over time than you'd have in saving your mortgage interest. The emotional return side of it, paying off a mortgage early gives you something else, a sense of freedom, owning your home outright, especially if you're approaching retirement, bringing huge peace of mind. Imagine the security of not having that monthly payment hanging over your head. So ask yourself, are you more focused on maximizing your financial returns, or do you need that peace of mind right now? Now let's talk about the taxes. Here's how each choice plays out when it comes to tax savings. So the 401k benefits contribute to a traditional 401k lowers your taxable income, which can help reduce your tax bill this year. And because the money grows tax deferred, compound interest is working for you. And you're not paying taxes on the growth until you withdraw. For the mortgage interest deduction, mortgage interest is used in your big tax benefit, but recent tax changes have made it less impactful for some people. It's still worth considering, But in many cases, the deduction might not outweigh the benefits of a tax-deferred 401k. If your 401k pretty much its tax benefits outweigh the mortgage interest deduction, it could be worth prioritizing retirement savings. So when does it make sense to prioritize one over the other? Here are a few scenarios to keep in mind. Prioritize 401k if your mortgage interest rate is low, think below 4 to 5%. You have an employer match on your 401k, you're behind on retirement savings, or want to catch up quickly. Prioritize mortgage payoff if you're close to retirement and want to eliminate the monthly payments for more flexibility. Your interest rate is on the higher side and reducing debt, which gives you peace of mind. You're not comfortable with the risk in the stock market and like the idea of having that full paid off home. These are just general guidelines, but they can give you a sense of what might work best for you. Sometimes the answer is blend of both. You might put enough into your 401k to get the full employer match and then throw any extra cash towards your mortgage. That way, you're still building your retirement saving while gradually paying down your debt. Let's say you get bonus or even a tax refund. Consider splitting it between your 401k and your mortgage. This balanced approach keeps you moving forward towards your goals. So should you put more money into your 401k or focus on paying off your mortgage faster? It depends on your priorities. You're in a financial journey. Ask yourself, do I need growth potential of a 401k more, or would I prefer the peace of mind of being debt-free? If this video helped clear things up for you, please hit the like button, subscribe, and share it with anyone else you might be facing the same situation. And if you're interested in more tips, on building wealth, check out the next video. We'll dive into creating passive income streams for retirement. Thanks for watching. We'll see you on the next time.